All right, guys, welcome to this long overdue video on time-based ranges. I think this video will be very powerful for many people who they understand what they should look for, but they don't know exactly where to look for it. So when looking for a trade, most people trade a particular pattern, including ICT traders, whether it's waiting for the time for that pattern to show up or whether you're just trading the pattern itself. You are trading a pattern. It can be an engulfing bar, it can be support and resistance, right? That resistance turns into new support. We trade higher. It could be market structure. You break the market structure low and then tap back into the previous range as we trade on this channel. It could also be that price is giving us the Quasimodo pattern, right? We begin to trade lower. It could be according to some volume that's back here, but we're looking for opportunities that are within here based on patterns, right? Whether it's a closure below the candle, whether it's going under the EMA, whether we see some exhaustion at the top, it's all pattern that we are trading. But most of the time, we struggle with where to trade that pattern because these patterns show up everywhere. But if we don't know where to take part in them, then we end up struggling with being too early or too late or simply managing improperly. So the goal of the video is to help you guys find trades on your own independently based on the model that you already trade with and answer some of the questions or solve some of the problems that many retail traders face in regards to not knowing when, where, and how. Be sure to like this video to support the channel, subscribe if you find this information helpful, and turn on the notification bells to catch our live streams as well as any other video we drop on this channel. All right, guys, so let's cut straight to the point about what we're looking for. We have this 9 o'clock candle that's present here, right? These are numbered 7, 8, 9, 10, 11. This is Eastern Standard Time. Anything taught on this channel will always go based on Eastern Standard Time. So this is a 9 a.m. candle. What we see is that this 9 a.m. candle is bullish. Does that matter to us? No. What actually matters is where price closes after the 9 o'clock hourly candle prints. So what we see here is that the 10 o'clock candle closed up above the 9 o'clock candle, right? So what we are using, since this is considered time-based ranges, what we are using is the range itself, the 9 o'clock candle's range itself. This 9 o'clock candle becomes a POI itself, right? So what we do is we take the fib from the high to the low of the candle. And being that we got the closure above here, what we want to see is price trade back into the range of the 9 o'clock candle and then produce a move trading in the opposite direction. So there are a lot of times when the market opens up and by 10, 11 o'clock, people are looking to trade higher with price. And what we see is the market moves back the other way into the 9 a.m. candle. And now you have a lot of people looking for the market to go lower below the 9 a.m. candle. And what does price end up doing? Price ends up turning back to trade in the direction of the 10, the 11 o'clock candle. And by lunchtime, we've put in another high. So again, the way that we mark out our POI using the time-based range is with a rectangle tool and our fib, right? If you're new to the channel, then you should know that our fib only has 3 levels on it: the 30, the 50, and the 70. That's 0 0.3, 0 0.5, 0 0.7. So using that from the top to the bottom, or on the bearish side from the bottom to the top, and then you'll use those levels to look for lower time frame confirmations to trade in that higher time frame expected direction. So on the bearish side, this would be the 9 o'clock candle if we were using it with the same orientation as the bullish side. But there are times where the 9 o'clock candle may be this candle here, right? You might have 10, you have 11, You have 12, you have 1 o'clock that trades back to that 9 o'clock range. So all we would do is take the previous range of that candle. You see there's no closure up above the 9 o'clock candle. The closure actually happened on the downside. So we would take this same 9 o'clock candle, draw it across, use the fib the same way that we did on the bullish side, and we'd look for price to tap into one of these levels up above. And when it trades into this level, we would be expecting price to move in the opposite direction. So it can be any candle that presents itself as the 9 o'clock candle. We would just need a closure above or below the 9 o'clock candle to use that 9 o'clock time base range as a POI for price to tap back into and then give us a rejection going the other way. So, as we mentioned, any candle can be the 9 o'clock candle. The thing that we need to pay attention to after the 9 o'clock candle closes is where the next candle closes. Now, as you see here, when we use this example, there was no close up above there, but the close didn't happen until this candle. So this would have likely been the 11 o'clock candle. So if this closed on the 11 o'clock candle, price can still trade away for the rest of the day and come back here tomorrow to tap into that 9 o'clock candle and then give you that rejection out. So this is not something that happens in every session. I don't want to give you false expectations that the 11 o'clock candle should go back into the 9 o'clock candle and then price trades out. There's no such thing as that. If price moved in such a mechanical way, then many of you guys would already be millionaires and you would not be watching this video to learn how to refine your trading, because it would be as mechanical as going into the previous candle and then trading out, right? So we have to follow price and follow Christ, and that's on rice, but we have to follow price and allow price to show us what it's doing, when it wants to go there. And when it gets there, it will give us lower time frame confirmations to be able to trade out of there just the same way it has in history. You can go and back test this, you can forward test this, and you're going to see some similarities around it. Are there times where the 9 o'clock candle gets liquidated? Absolutely. But we'll go over what to do when that occurs. So to save time, there are two candles that this particular occurrence can happen on. It's on the 9 a.m. candle and the 3 p.m. candle. Remember, Eastern Standard Time. So that's the 9 a.m. candle and the 1500 candle. So just the same way we marked out that this was the 9 a.m. candle and this was the 9 a.m. candle to the right, right? This could also be the 3 p.m. candle, the 1500 candle. And while the 9 a.m. candle may benefit New York traders, the 3 p.m. candle can benefit London traders, to where London traders can find POIs that are around or near that 3 p.m. candle to be able to take trades going in the opposite direction. But I'll show you guys this on the chart so I could make you a believer. So I'll start with NQ since this is primarily what we trade. I'll use the indicator by Wang Indicators. This is the structure pilot indicator. I'll use it to highlight the hourly candles that I'm looking for in question. So currently this version of it is highlighting the hourly candles for the 9 a.m. candle. That's what I have as the opening range that's here, 9 to 10 o'clock. I'll ask them if they can edit it to create a second one to where they're able to mark out both the 9 a.m. and the 3 p.m. candle. But what I'll do is manually mark out the 3 p.m. candle, and you guys can take a look at the 9 a.m. candle that it highlights. So what we see is the 9 a.m. candle is here, right? You see price tap into the 9 a.m. candle after the closure. And what we see is this move trading out of it. That's a pretty large move leaving, right? So we also have this one here where price closes below that candle, taps back into it, and trades down. It also trades back into it the next New York session. This looks like a day later, and we see price hit the 50% of it, and we see a huge drop running from the 50% of it. But on this 9 a.m. candle, we have this is Thursday, December 7th. We also have a closure that's there where what? Price taps back into the 50% of it. And then what do we see? It trades higher, right? But let's go through the rest of this. We also see the 9 a.m. candle here. Price taps back into the 9 a.m. candle, trades higher. We see the 9 a.m. candle here. This is on the 11th. Price taps back into it, trades higher. So you guys sort of understand what I'm looking for, right? I'm looking for a closure above the 9 a.m. candle, and then for price to tap back into the 9 a.m. candle and give you a push going into the opposite direction. Now, let's go back down here. And I guess I missed this 9 a.m. candle back here as well. You see price tapped into 9 a.m. candle and rejected down. So what we want to do is manually mark out the 3 p.m. candle. So here are all the 3 p.m. candles marked out in the same area that we went through with price closing below. The red lines represent the closure. So we get a close down here in London. You see price tap back in to that closure, that 3 p.m. candle, and it rejects. We see the closure that happens up here. Price comes right down and violates the low of the 3 p.m. candle. We talked about how this can be violated. So over here, we see price taps into the 3 p.m. candle and then trades away, right? Up here, we see price close below the 3 p.m. candle, tap back into it, and then trades away. So we see the common theme and pattern of price tapping back into these 3 p.m. candles and trading out, the same way we saw price tapping back into the 9 a.m. candles and trading out. So, as mentioned, both the 9 a.m. candle and the 3 p.m. candle can be swept. But one thing that I've noticed around the sweeping of these 9 a.m. candles and the 3 p.m. candles is that when we get a sweep below, oftentimes there's an opportunity below it to trade back in to that range. Same thing here. There's a sweep above this 9 a.m. candle. This was likely a news candle that came in. And what did we see? Price turn around and trade back towards that 9 a.m. candle. So you can back test this if you want. When it comes to the sweeps, I see oftentimes that price does hold, but when it is that you do get that moment where price will sweep the candle, there's a possibility for you to find an entry on the other side, as that sweep seems to be a very important sweep to be able to turn price around back into the other direction. So here's a few more that failed after the closure. What we see is price traded up above, gave us the body close. It never came back to it until over here to the right. We saw the sweep of it below, and then what did price do? Run back into the range. So here's another one up here. Price closed below, there was a little tap away, but price went up to sweep it. When price swept it, we saw a move going back into the range. We have another one here. There's a closure up above. Price taps onto the top of it, fails to go higher, then it sweeps it. After it sweeps it, what does it do? It turns back into that range. And here's another one here. What we see is price closes up above, taps back on, fails, and then sweeps it. But this is likely news, so we had this large extension down, and then we ended up down here. So down here we have what? Another 3 o'clock candle right here, 3 p.m. candle with a close. We see price close up above it, we see it tap back in, and then we see it trade higher, right? So we don't want to necessarily pay attention to the ones that, we lose entries on, right? Or the ones that do not hold. Just wait for your particular confirmation to occur in there. It could be from any strategy. It can be support and resistance. It could be the strat. It can be SBS. It can be uno, dos, tres from Pepe. It can be whatever it is that you have out there. Just wait for price to get to these areas. Wait for price to have these sweeps, and then it's higher in likelihood that your entry will work out. But I'm not promising that every single entry is going to work out. You still have to manage risk. You cannot be trading in these environments without a stop loss. You cannot trade and think that you do not have to cover your position. Price can 100% go against you. We've seen how many times this thing works out, but we'd also see times that it does not. These are hourly POIs. So the risk is larger behind these zones, and what you want to do is reduce your risk by looking for lower time frame confirmations. And those lower time frame confirmations will allow you to pay peanuts to eat caviar. I always tell people that my model for trading is that I want to risk a little to take home something that is worth it. I do not work for free. I do not want to come into this market and expose myself to a certain level of risk, even if it's small, and walk away with nothing. That is always my goal when I'm getting into a trade. How can I pay myself for this work that I'm currently doing? Because I do not work for free. So to take a minute and look at a different asset like gold, right? Whenever there's a sweep, there's a push back in, right? Whenever there's a sweep below, you get a run back in, right? Whenever price closes up above, you get it to tap back in and trade higher, right? So There's a ton of things that are here within this concept, right? Here's another one right here. There's another one right here with the closure, right? Price taps onto there. There's another one right here with the closure. Price comes back and taps onto it and trades higher. So I've explained this thoroughly and in detail, and when it fails versus when it holds, how to look for an entry based on whatever concepts it is that you trade. It does not have to be DTFX concepts, but you need to know where to start your position, where to begin looking, and it needs to be data driven. So if you ran the numbers on this, if you went and back tested it, maybe you see a sweep and then you look for the model after the sweep of it, or you look for the model while it taps into it. Look at what the win rate is like over time, and you'd be able to find some stability within your trading. For the sake of time, I'll speed run some of these assets, but you're going to see some of the same things. Here's a closure here, price does what? Tap back in, trade higher. This is ES, by the way. Closure here, price does what? Tap back in, trade higher. Closure here, price doesn't return to here. Closure here, right? Price does what? Tap back in up here and then trade higher, right? You get a closure here, price does what? Liquidate it, what? Trade back into the range, right? You get a closure here, price does what? Liquidate it, trade back into the range. You get a closure here, price does what? It just continues down. It leaves this behind, right? You get a closure here, price does what? Tap back into a trade lower. You get a closure right here, price does what? It rejects out of it, absolutely, but when it trades back up above it, it trades back into that range. You get a closure here, price does what? Trade below it, run back in, and then reject out, right? So there's a ton of different things you can utilize with this, a ton of different concepts, a ton of different ways to get in. You could look for your confirmations based on whatever school of thought you actually trade from, but make sure that it's in and around these particular POIs because they're high in likelihood for price to respect or give you where to look for your entry next if price doesn't respect the POI itself. To run through this same thing again, we see the 3 p.m. candle, right? So what we have is we get a sweep right here, right? First we get a closure up here, we sweep it below, and then we see a move running back in, right? So you continue through this, you get a closure above, price sweeps it, runs back in. This same thing is occurring everywhere. You get a closure that's here, price taps back into it, trades lower. You get a closure there, price sweeps it and continues down. Hey, that's going to happen sometimes, right? But you get a sweep that's down here, price does what? Trade back into that range. You get a closure right here. Price does what? Tap back into the range and trade out. So we see how valid this is. Another closure here, price taps in, trades out. So whether it's the 3 p.m. candle, whether it's the 9 a.m. candle, you can use both of these candles in dynamic ways to be able to find entries that will hold or find entries that are higher in likelihood to hold. Let me say that. But we can go to any asset, every asset you want, and look at it through this same lens, and you'll see that oftentimes price does reverse on the sweep of it, or oftentimes when price taps back into it after a closure, you do get a nice move on the lower time frames being able to trade in the opposite direction. So for the people who have struggles with counter trending and holding because they don't want to be wrong, so they dollar cost average into their entries, you need to trade in the fold of this particular dynamic happening in price because your entry is higher in likelihood to hold. And instead of getting burnt on those positions where you enter into a trade and because you're not sure about the position, so you remove your stop loss and price just begins to dump into one of these directions, now you can just wait for it to get to these areas, right? Wait for it to get to these POIs and time it properly. Yeah, you're going to take some losses, absolutely. But it's better for you to take entries in data-driven, data-backed price cycles. So we understand that every time there's a sweep, we often see a move going back into the range. We also understand that every time we get a closure, there's a high likelihood for price to tap back in. So now you have two, possibly three entries around two candles with different kinds of behavior to it, different kinds of volatility. You can trade them in different sessions to where price will be on your side. Most times, go and back test it. If you take entries, lower time frame entries, in these POIs, you'll see that more likely than not, your model works out better than just randomly grasping at straws and taking the model wherever it is you see without it being in a particular area of interest. Now, I can go through every single asset and back test it with you, but you can do the same thing yourself. Go back into the history of some of the trades that I've called, some of the POIs that I've mentioned. Hey, I want a short here, I want a long here. Even go to the last stream that just occurred on Friday, and you'll see that I mentioned I wanted a short from a particular POI, right? But look and see if this POI is present. That'll help to show you that this is something that I am looking for and something that I am trading in real time and something that you can trade in real time too. You just have to be able to spot it. You have to be comfortable with it. And you're only going to gain that level of comfortability with back testing, with the reps, with seeing it more times than you don't. So you need to isolate this and then forward test it, create a plan around it. When it gets into the POI, what is your lower time frame confirmation to get in? That can come from anywhere, not just DTFX. But this is my gift to day traders. I used to day trade a lot. I don't really day trade as much. I might take one trade during a day, but more times I'm swing trading now. I do have a time-based range and time-based POI for the swing time frame, the weekly, the monthly. This thing goes into so many different assets, so many different markets. It's insane, but this is just the one that I wanted to wrap up and give as a gift to those who are still trading the lower time frames. And I'm also letting you guys know that you don't have to live on those seconds time frames. You can go into the 5 minute and take the 5 minute entry that's around this particular constant, right? You can take the 1 minute entry, you can take a 15 minute entry. You might be able to just take the range itself and take a 1-to-1 on the range. But there are so many different creative things you can do with this where you don't have to keep getting cooked on the lower time frames. Neither do you have to work like an elephant and eat like an ant. You can do more with your time if you just learn to refine and then move up a time frame. That will buy you more of your time to do things in the real world. So I hope you guys enjoyed this video, and be sure to tag me on X at DaveTeachesFX to let me know that this video has helped you with some of your entries during intraday. And as always, I appreciate you guys for all the support that you've given me thus far on this channel. Take care, and I'll see you guys in the next video.